name is Tyson Mavar. I'm one of the Chevron-focused retirement advisors for the retirement group here in Texas. Today, we're going to be talking about the Chevron pension interest rates. Many of you probably saw this week the IRS published the January corporate bond interest rates that have very big implications on the lump sum payouts for anybody that's approaching retirement especially. So I'm going to go ahead and zoom in here so we can compare these rates historically over the last 2 years at least. So here's what came out in January. The first, second, and third segment rates, those are based on short, intermediate, and long-term corporate bonds. The second segment rate being the most relevant of the three, carrying the most weight, for instance, because it's 3 times more relevant than the first segment rate. But all three rates went up. Now, first, let's review the timing issues with the Chevron lump sum pension. The company will look back to the third, fourth, and fifth month prior to the month that you are commencing your benefit. So here we are in February. They just released January's rates. January's rates won't be relevant until folks that are leaving in April, because April is going to look back to not March or February, but January, December, and November, the third, fourth, and fifth month prior to April in this case. So if you're somebody who is on the fence between leaving in March and April, might be a consideration to leave and commence your benefit in March, which means you basically have to leave by the end of February to get a March 1st commencement and not have January be a part of your calculation. Look at this on the second segment rate. The rates have gone up 30 basis points. And the relationship we remember is for every 1% increase to the rates, you can expect about a 10% drop in your lump sum. And of course, January is only 1/3 of the total calculation, but that's a pretty substantial increase for 1 month. And if we see these things take off throughout 2022, you could see a slow deterioration or maybe even a fast deterioration of your lump sum. And you need to be, especially for those of you considering leaving the company soon anyway, in the next couple of years, I would say, reevaluating your retirement plan to see what this interest rate impact has on your specific lump sum in dollar terms, and compare that to the benefits of continuing to work at the company. So you have a true analysis of what are the costs of staying, what are the benefits of staying. And I think this will help you in determining the best time to leave, to not leave any money on the table and not work for free. First and foremost, we've seen rising interest rate environments in the past that resulted in people working literally for free for the company because the losses in their lump sum were close to equivalent to what they were earning in salary and other benefits that active employees receive from the company. Let's go back here. We saw some very low rates back in December of 2020. 2.26 was the second segment rate. So we've already seen 75 basis points roughly, could be a 7.5% drop in lump sum since then, just as a result of the interest rates, of course. Your added service with the company will grow your lump sum. As you get closer to age 60, you'll be aging out of penalties, which will also grow both your lump sum and annuity. But there's some moving parts here that we found far too often people do not have a good grasp on. And it's very important that you get a grasp on these as you get close, so you don't leave tens of thousands or even hundreds of thousands of dollars for some folks on the table because these rates moved too quickly on us and you had less money in your pension as a result. Fortunately, looking back at March 2019 at the bottom here, you can see rates are still quite a bit lower than they were 2 years ago. So we're still in a relatively favorable environment to leave the company and take a lump sum historically. But there's a risk of staying at the company and a risk of leaving your pension at the company is what these rates are going to do to your lump sum. So I encourage you to spend some time with us if you haven't done so already, or if it's been a while since we've had a chance to talk. Please reach out to us at the home office. Our phone number is 800-900-5867, and somebody will help you get on the calendar of one of our Chevron-focused retirement advisors. You can also email us any questions or a request for a meeting at info@theretirementgroup.com. This QR code here on the bottom left will get you on one of our Chevron-focused advisors' calendars. And this QR code here on the right will get you a link to our LinkedIn page where we publish a lot of content like these videos to keep everybody up to speed with what's happening with interest rates, as well as what's happening with the tax code as it pertains to the Chevron benefits and some of the decisions and some other retirement strategies that we found valuable to Chevron employees and folks that are approaching their retirement from the company. With that, we're going to wrap it up today. We appreciate everybody joining our webinar series on interest rates. Hope everybody has a good, safe rest of the week, and we hope to talk to you all again very soon.